Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. We want to give you an update on what we're seeing today in the economy and the financial markets. First, I think there's a lot of questions about what the current war between Russia and Ukraine means for the financial markets. Does that mean that there's going to be a crash happening in the stock market because of this international conflict? If you look back at the history going all the way back to the start of World War II, you'd see that's not the case. Actually, if you look out a year ahead from when these different military conflicts started, the majority of the time the stock market was trading higher than it was at the beginning of the conflict. What this suggests to us is that it's not so much about the war itself, but about what the underlying conditions were for the economy, the financial markets, a global and monetary policy, things along that nature, which we were defensive about going into the year. And so what we're still paying attention to is those key issues. While we're monitoring the war, I think that's more of an add-on rather than what the core things are for us for the rest of the year. One thing we have noticed is that inflation is accelerating higher, and you're seeing that in oil prices, the price of gas when you're filling up your car, but even with food prices. Annual inflation in food right now is increasing at the fastest rate since 1981. And what that means is that the Fed, which has not raised interest rates on the short term, the Fed funds rate, they're still stuck at 0.5%, is very behind the ball in trying to stop inflation. Inflation, if you look at the numbers for February, annual inflation increased by nearly 8%. And the last time that happened, if you go back more than 40 years, the Fed funds rate was 13%. So compared to now where you're still below 1%, the Fed is going to have to really try and aggressively raise rates to slow down inflation over the next 12 months. What that means for financial assets is the mandate for the Federal Reserve has changed from what it was for the past 13 years. Since 2009, the Fed's mandate has been more focused on stimulating economic growth and lowering the unemployment rate. But now, whether they're hearing it from politics, from businesses, or from consumers, the one goal everyone is focused on is how do you slow down inflation? So they're not going to be there to provide a backstop if the financial markets start to fall off as they're fighting to slow down the inflation rate. So this worries us as an investor because in previous cases, looking back 50 years, when the Fed is raising rates aggressively like this, something tends to break somewhere in the world. We've got examples of the Fed hiking rates and leading to crises in the UK, Latin America, Mexico, Russia, Asia, and the last few times it was here in the US or globally, whether it was the dot-com bubble, the housing bubble, and then in 2018 we had a 20% decline in the market over 3 months as the Fed had to backtrack when they took rates too high. So for us, we're really monitoring this and seeing what the Fed is planning to do and knowing the history of this usually not working out so great for investors. So when we see that the Fed is now positioning to raise rates 6 or 7 or more times over the next 12 months and take short-term rates up to 3%, we don't think that's a great environment for financial assets. And just looking broadly, when the Fed is during a hiking cycle, stock returns tend to be about half as good as what you see when the Fed is in an easing cycle. And you might have seen some stats about, in the first 12 months after the Fed makes its first rate hike, which occurred 2 weeks ago, the market tends to be higher. That's true the majority of the time. The market is higher 12 months later, but you're not really risking that much on the upside if you're positioned defensively. We went and looked at the last 50 years worth of the start of rate hike cycles, and in none of the cases was the market up more than 9% a year later after that first rate hike. So we don't think we're missing out much on an opportunity by not being as aggressively positioned at this point. We're more concerned with the potential downside if the Fed does hike rates up to a level that tends to break something. The last thing on this is specifically when the Fed is going to increase rates at least 6 times over the course of the first year of this cycle. Historically, markets are down in the first 2 to 6 months after that cycle begins. So again, just more reason to be cautious. Looking from the bottoms up at stock valuations, we showed this statistic in our February update, the long-term appreciation potential that Value Line tracks. Back in February, it was at 45%. Today, it's a little bit higher at 50%. But basically, we think things are fairly to slightly overvalued, and we need at least a 20% decline to think that the odds are really in our favor to be more aggressive with our portfolios. The past 3 bear markets that we've experienced in 2011, 2018, and early 2020 were all very quick in nature in terms of, it was no more than about 3 months in each case that the bear market began and then bottomed within 2 or 3 months. But if you look back through 60 plus years worth of data, there are more extended bear markets that we think actually are more in play with what we're experiencing today. Because the Fed is being forced to really try to increase rates to slow down inflation and cannot jump in to accommodate the financial markets as soon as we see any sort of correction or 20% decline, we think there's a greater chance that this could be more of a drawn out, choppy period, potentially a bear market. And if you look at this chart from Investec Research, it just gives you an idea that this could last well into 2023, where you're best off being defensively positioned and staying flexible in your portfolio and keeping some liquidity. And that's what we're doing. In the last month in our long-term growth portfolio, we've sold a handful of our stocks. So today, the actual stocks portion of the portfolio is about 66% invested. Now, we didn't sell more than that because all of our research of the great investors of the past century suggests that you want to keep your winners and hang on to them until you see something significantly change with those businesses. And we're fortunate that we have a large number of positions that we have significant unrealized gains. We've kept a handful of them on this chart here just to show ones that we've owned for at least 5 years. So we want to keep those positions, but at the same time, we want to have more around what would be the equivalent of a 40% cash position in the portfolio. So what we've done in the meantime is we bought a 6% position in a fund that moves the opposite of the S&P 500. So if the S&P 500 goes up on a day, this position will go down by an equal amount. And if the S&P 500 goes down, then this would go up. What this does is it acts as a small hedge so that if stocks do go down in a significant way over the next year or two, this position would go up in value and provide some ballast to our total portfolio. If we do decide to sell 1 or 2 of our stocks in addition to what we've already sold, we would get out of this inverse position and just be a regular 40% cash. Also, if we did see stocks decline and become very attractively valued, this inverse position would be the first thing we would sell because we then want to get more invested in regular stocks. But for right now, we think this is the best balance to have, just given the choppiness that we project over the next year. We hope that gives you a sense of how we're seeing the markets today and what's happening in the economy and with the Federal Reserve's policy. We think it's best right now to be defensively positioned, flexible, and maintain a lot of liquidity in your portfolio. If you have any questions about this, please contact us.